Hi there, welcome to Kneppy Invests. August 31st, the last day of August reporting month is almost upon us. We have a few more minutes left of trading. I'm recording this video at 3:57 p.m. So 3 more minutes of normal trading and then we'll have the closing auction, which should be completed by about 4:11 p.m. And this is technically the last day. All companies that need to report in August have to release their financial results. We'll get some stragglers releasing their results tomorrow morning on the 1st of September, but they have to release that before trading begins or otherwise they'll be suspended from trading. Even though August is one of my favorite months simply because it is reporting month, I am happy it is over because we've had a plethora of results being released over the past few weeks. In fact, I'd say about 20, 30, maybe even 40 companies release their results on a daily basis. And I do try to have a quick look, at least a quick look at every single report that is released. And one of the reasons I do that is I will come across companies I haven't really taken notice before in the past. And I do list all the companies that release their reports, and I circle the companies I want to have a closer look. And that's true for the company I'll be featuring in today's video, Readytech. This company did list on the ASX April 2019, so they've been listed for just over 2 years. But their results they've released this year was the first time I've decided to take a closer look at this company. And there is a main reason I've done that, and that's in regards to some guidance they gave us for year 2026. And the fact that they're thinking that far ahead made me want to research this company a little bit more. So before we have a look at their financial year 21 results, just a few facts in regards to Readytech. Readytech is all about people management software, and they do have 3 verticals: education, workplace solutions, and they've just recently got into government and justice. So this is all about how do we manage people within those different verticals. For instance, in their education vertical, it's all about managing students. So they've created software that allows education institutions to do that. The company has been around for a while, founded in 1998, and the current CEO is a co-founder, Mark Washburn, and they listed on the ASX on the 17th of April 2019. I do like to see what sort of skin in the game the founders, if there are any founders left, have. And at this point in time, Mark Washburn, based off their annual report, you can find this information in the annual report right at the end where they do have a list of all the major shareholders in the company. And Mark Washburn has 2.8%. Pemba Capital, which I do think they are a private equity fund, and before Readytech listed in 2019, Readytech was one of their investments, and they still have a bit of an investment in Readytech, and that amounts to 33%. So by far, the largest shareholder in this company is that private equity fund called Pemba Capital. Market cap of Readytech at $3.06, and last time I looked, share price was about $3.28. So I prepared this video a few days ago when the share price was a little bit lower, 326 million. So you do have to take that into account. The share price has increased over the past few days because of the good financial report they did release. T code of Readytech is RDY. Now on to the full year results for Readytech, looking at revenue, operating cash flow, net profit after tax, underlying net profit after tax, and before amortization. I don't like to look at net profit after tax for this company because they do have pretty high amortization. Now they do also look at EBITDA. I don't like to look at EBITDA either. Charlie Munger does call it BS earnings, and the reason he calls it BS earnings is because earnings before interest, taxation, depreciation, amortization. Now interest and taxation and depreciation are all real costs. So why do companies and a lot of analysis completely ignore all those real costs? That's Charlie Munger's viewpoint. I do think the reason they do that is because it's quite a bit higher than net profit after tax on occasion. And we'll be able to see that with Readytech. I do prefer for Readytech to look at net profit after tax and before amortization, because amortization is quite high because they are an acquisitive company, which means they make acquisitions. And when they make acquisitions, they're a little bit conservative when it comes to amortizing the acquired software and client lists. And you'll notice that net profit after tax and before amortization is quite a bit higher than net profit after tax. And let's actually look at the numbers now. So I'm already starting to do it. So revenue, $50 million. That's up 27% from the previous year. And organic revenue is up 15%. This company, I've already mentioned, are acquisitive. They do acquire. They've made a few acquisitions in the past few years or since they listed on the ASX. It's always good to see how organic revenue is growing or any sort of organic growth in the company, because particularly those companies that do acquire, I like to see them separate that to see how the company is growing organically and how they've grown with their acquisitions. Operating cash flow, almost $20 million for the financial year, up 42% from the previous year. And you can see net profit after tax, $2.2 million. That was down 45% from financial year 20. And if you looked at net profit after tax in isolation, you might think this company is performing badly. But the market completely ignored that because it's not a true representation of how this company is performing, because their underlying net profit after tax is up 37%, and the underlying net profit after tax and before amortization is up 27% to $10.6 million. They also provided EBITDA, which I'll show you in a few slides. This company does have debt, $19 million of net debt. We'll also look at the debt in the future slide as well. And EV to operating cash flow, one of my favorite metrics at 17.7. That is a little bit lofty, but this company is growing, and their ambitions for the next 5 years does suggest if they are successful with those ambitions, this company will be valued at a significantly higher rate than it is right now. This is a little snippet from one of their announcements they did release on the day. A lot of times you'll see when a company releases their full-year results or half-year results, they release about 3 or 4 announcements, a presentation, the full accounts, which could be 50 to 100 pages long, and then maybe just a summary, a 2-page summary or 3-page summary. So this, I believe, was in their summary, talking about how revenue is growing, excluding the acquisition they made of Open Office, customer revenue, retention, underlying EBITDA, and underlying net profit after tax and before amortization, and operating cash flow conversion. You'll notice here they don't mention net profit after tax at all. And that's typical of companies. All companies, they do want to put a positive spin on their results. And that's what they've done here. They've decided to leave net profit after tax because it has gone backwards, and they want to retain that positiveness when they're talking about their results. Always like to look at why there's the difference between net profit after tax and operating cash flow, and they do provide this in note 37 in the report. They start off with the profit after tax, which was $2.2 million, and they worked their way backward trying to get their operating cash flow, which was, what again, $19.5 million. And the adjustments for depreciation and amortization, $11.1 million. That's pretty high, particularly amortization. So they are amortizing the acquired software and the client list. And a lot of companies can be a little bit conservative on that, and maybe too conservative in my opinion, because sometimes when they acquire client lists, they assume that those acquired clients won't be a client in another 4 or 5 years, so they amortize out of those clients over that 4-year period. And there is a possibility that a lot of those clients they have acquired will remain with or remain being customers or clients after 4 years has lapsed. And this does happen a lot. I saw this first with M2 Communications about 8 years ago when they did an acquisition. They acquired some clients and they assumed all those clients will be gone within 4 years. And of course, the majority of those clients they did acquire were still with M2 Communications after those 4 years. And it does suppress net profit after tax. And at that point in time, M2 Communications had a PE ratio of 12. The share price was just going sideways while every other telecommunications company at that point in time was rising quite rapidly. And I think at one point in time, the market realized this and we saw the share price of that company take off. So you have to take all these things into account. Now, I'm not an expert in accounting at all. It is something I'm learning myself right now, particularly when it comes to depreciation and amortization. I want to learn way more than I know right now. So that's one of the reasons I look at this reconciliation of profit after tax and operating cash flow. The first thing I always look at when it comes to a financial report, whether it's the full year, half year, or an Appendix 4C, is the cash flow statement. And the main reason I want to focus on the cash flow statement is we get an understanding of how the company is performing in the day-to-day running of their business. And we know this by looking at whether the company is operational cash flow positive or negative. Now, the first thing I always look at is receipts from customers, which should be fairly similar than revenue. And when it comes to receipts or revenue, I want to know the trend through time. And we'll look at the trend through time later in this video. But the most important thing, in my opinion, about the cash flow statement is whether the company is operational cash flow positive or negative. We already know, because I've told you, that Readytech is operational cash flow positive by $19.5 million. Now, a lot of companies, particularly small cap companies, and particularly when you look at Appendix 4Cs, there's not a lot of happening in the investing and financing activities. So I can go through that or browse through that fairly quickly. But when it comes to Readytech, a lot is happening in their investing and financing activities sections simply because they made an acquisition. And that acquisition, if I remember correctly, open office was $40.3 million, which is line 1 in the investing activities. And to fund that, we can just go to the financing activities and see they did a capital raising, $27.7 million, which is the first line. And they also borrowed some money to the tune of $6 million, which is just the proceeds from borrowings minus the repayment of borrowings. Now, when it comes to loans, I prefer companies to have as little debt as possible. Now, some debt is okay. I want to know, when it comes to any sort of debt a company has, what sort of interest rates they're paying. I've seen some companies, particularly small cap companies, have interest rates of 20% or more on their debt because those sort of companies have higher risk. So even though we're in a low interest rate environment, still want to check out what sort of interest the company has to pay on their debt. And Readytech have two facilities, facility A and B, and the interest rates on both of these debt is set at BBSY, which is the bank bill swap bill rate, plus a margin of 2.3%. So this is variable because of that BBSY. If we start to see interest rates go up, Readytech interest they have to pay on the debt will increase as well. So it does look like these debt facilities are easily handled, or should be easily handled by the company because they do have low interest. But moving forward, particularly if we see interest rates rising over the next 5 years, they want to make sure the debt doesn't get too large. I've already mentioned that Readytech have 3 different verticals: education, workplace solutions, and a new vertical or division, government and justice. If a company doesn't release a presentation, you can find how the different verticals or divisions are performing in their financial report most of the time, not all the time. And if they do a presentation, a lot of times they will provide this for you, and Readytech did that. They did provide how the different verticals are performing. They've broken down that into this nice little table. Unfortunately, they're only looking at revenue and EBITDA and EBITDA margin. I would prefer a different metric than EBITDA, but this is all they've given us. And all 3 verticals, well, I shouldn't say all 3. Education and workplace solutions have grown from the previous year. Revenue have grown at 16.9% for education and 13.3% for workplace solutions. EBITDA has grown quite quickly for education, up 32%. That's because the margins have grown, but it's the reverse for workplace solutions. Margins have gone backwards, so EBITDA has not grown as quite as quick. Because government and justice is a new vertical in the business, we don't have any information on how it's growing, but revenue starting at 4.8 million, and it is EBITDA positive at 1.7. Have to wait to next year to see how government and justice is growing. Maybe it's going backwards. We don't know at this point in time. More than likely, it will grow because there's no reason they should introduce this vertical if it doesn't have the potential to grow in the future. One thing I always like to look at for companies is to see how revenue and operating cash flow grows through time. The main thing I want to see here is growth. So an upwards trend in revenue, and we have that with Readytech. So I only have 6 quarters of history here, and I got this information from Ticker. More than likely, even though they've only been on the ASX for 2 years, some of this information might be from their prospectus. And when a company releases a prospectus, they actually do provide the annual report from the previous 2 years, if I remember correctly. And revenues have grown at a nice little clip for Readytech, growing from 15.8 million to 28.2 million through 6.5 years, which is 3 years. And this company has become more operational cash flow positive from 1.4 million to 13.6 million. So this company is showing some operating leverage, which means as their revenues grow, their costs don't grow quite as quick, which also means this company will become more profitable as their revenues grow through time. And as they become more profitable, that operational cash flow should increase at a greater rate. And why this is important is simply because they gave us some 2026 guidance, which I'll talk about now. Before we touch upon that exciting 2026 guidance that Readytech have provided us, let's have a look at their 2022 guidance. This is only 1 year away, so they should have more expectations and be more confident on these expectations for the next year. And this guidance is on revenue, organic revenue growth, and EBITDA margin. They are expecting organic revenue to grow in the mid-teen range, and they are expecting EBITDA margins to be between 36 and 38%. This year it was 37.8%. The most important thing I took away from this is the company's management is expecting this company to grow over the next year. But it was actually the next bit of their guidance which excited me, because they gave us a 2026 target for organic revenue. So let's have a look at that target right now. It is quite rare for companies on the ASX to give us long-term targets, even though management should always be thinking about where the company is going to be in 5-10 years' time, just like politicians should do that as well, but they're always thinking very short-term. Not saying CEOs do that, but politicians always thinking very short-term. It's really good to see Readytech give us a 2026 target in regards to organic revenue, and that target is 125 million. Now we can work off that, because one of the reasons I do like companies to give us this is because we can work off it. For instance, EBITDA margins should be around 40%, making an assumption that EBITDAs will remain where they are right now or a little bit higher, which means EBITDA should be 50 million in 2026, and operating cash flow should be around $50 million as well. That means if I try to value this company based off this organic revenue, I get a possible market cap or value of this company around $1 billion by 2026, and that's being a little bit conservative. And that's also not taking into account any acquisitions this company might make, and more than likely they will make over the next 5 years. And to finish this video, like always, a chart of Readytech's share price from when they listed on the ASX in April 2019. This is the sort of chart you want to see for a company you have invested in, particularly what's been happening over the past 3 months. We did see the share price get as low as $1 during the COVID-19 financial panic after listing at around $1.70. But it's really been over the last 3 months where we've seen the share price rise from about $2.10, $2.20 to the current share price of $3.28. The market is becoming a little bit more excited in this company during this time period. The share price is at an all-time high, which does make sense because the financial state of this company is getting better and better. They've given us a financial year 26 target, which means a lot of those financial fundamental people can crunch some numbers, and they might be crunching those numbers, and based off the numbers that spit out, they realize that $3.28 is good value if this company can achieve their targets. That is all I have for this financial year 21 result video for Readytech. If you do know a little bit about this company and you'd like to share your opinions on where you think this company is heading, what you think about their financial year 26 targets, and whether you think this might be a buy, sell, or hold, I'd love to hear your opinion, your thoughts. So leave it in the comment section of this video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for your video. Have a good day. Bye.